Another week of straight red on TLT. Are you having
Yeah.
fun?
Hey man, listen, like it's just part of the process, right? Like we can't have new all-time highs every day. Like and we
It was
also
nice
can't
though. It was nice when we had new
it's
all-time highs almost every day for about 2 months.
right and like it's it's just part of the process. Like look, dips are normal and more I don't want to say severe, but more standard drawdowns are or even like above average drawdowns are to be expected. This is the game, right? So
Yeah.
the whole key here is not one play, but the sum of or the culmination of all your plays, and that is what makes the RQF. The RQF is time necessarily, right? Not just one trade. And the more positive or the better, the more gain, or should I say, the more exponentially profitable trades you put together versus moderately negative trades equals the CAGR that you see on that strategy.
Yeah. And it's important to stick to the rules, stick to a proven strategy, and that's exactly what I do in my personal account. I run full RQF, and some nice tricks that work well for me. Number one, do not open my account during these drawdowns. That helps my head stay level. I haven't opened my account in about a week now. And another thing is to just remember it's numbers on a screen. What are you scared of numbers on a screen? Red numbers on a screen? I'm not scared of that.
I
So those
I
are the two
completely
tricks that I
understand.
use.
Yeah, so for me, I think the way that I look at it, and similar to you, like staring at your account's going to do you no good. Most likely, it's only going to generate emotion. To be honest, it's just going to make you emotional. So not looking at your account is understandable. When you're running leverage the way that we are at 3x, everything is going to be enhanced. Your gains, those levels of that level of euphorism is going to be amplified. The drawdowns are going to be amplified. So this is a model that's technically hypothetical, right? You're not supposed what you guys do with it is up to you. I also run my entire personal account in RQF. And yeah, like we're in a 13, whatever, 12, 13% drawdown from the highs. That's an average drawdown, somewhat close to average drawdown in RQF. Some people will say that's ridiculous, but you show me how to get close to a 50% CAGR with having drawdowns, average drawdowns under like 5% or whatever some of these people want. It's impossible, right? If you want outsized, like if you want volatile returns, essentially you want outsized returns, right? You want returns that are so volatile to the upside, they're just above average. You're going to have to deal with volatility in the portfolio if it's to the downside as well, right? You can't just have one side of the equation unless of course you're running a highly sophisticated market making operation and you're talking about um, millions of small trades adding up over the over a course of a year, for example, right? That's not you, that's not me, right? Both of us we're just some bros running their personal accounts in a trading strategy, that in a trading model. That's really all we're doing. So we're not in front of the screens 24/7, right? We're not watching our accounts every single day. That does help with the drawdowns. It also helps you feel better when you're like some people will see their accounts hit new highs and then they'll go into a couple of percent pullback and they're like, oh my god, I could have sold up there, right? Again, spending less time in front of your screens, more time enjoying your life takes you away from making those emotional and just tragic decisions where if it's you know for example, if you're hitting new 52-week P&L highs or new all-time P&L highs and you get day after day, you're going to start feeling this urge if you're constantly watching it to like leverage up even more maybe than you should, right? Or if you're
Yeah.
getting just absolutely blasted into a drawdown, you're going to feel like this just natural instinct to make it stop, right? You want the path of least resistance, and you end up making inopportune portfolio adjustments when emotions arise. And our number one objective at Market Radar has always been just kill the emotion. If you can kill the emotion in your trading strategy, you have the odds have already improved for you, like just off of killing emotions, because it's just like the same reason someone uses a money manager or an investment advisor. They just don't feel comfortable making the decisions themselves because they are too emotional. That's all
Yeah.
it comes down to.
And that's why we put set rules for all our strategies for members to see. Like, this is exactly what we follow, and we do not deviate from it. If you get a losing trade, which RQF has losing trades, we will get losing trades. This one is working. We're still up on the TLT trade, the TMF trade, but let's say it didn't work out, and we do take a bit of a loss on it. At the end of the day, we followed the rules, and our strategy is proven. We have it back tested. We've done a lot of studying on it. It's taken us years to get to this point where we have this strategy that we trust and it works really well. If we take an L but we followed the rules, that's still a win. It's when you take an L because you broke a rule, that's where you start running into issues, and that's where you can go down rabbit holes that you may not come out of.
Right. I just want to clarify, like, just because it has worked in the past, right, is not guaranteeing any future results. I need to make that clear. Like, just
Yeah, of
because this has
course.
been proven in the past, right? Like, you shouldn't also be taking outsized risk. Number one, you shouldn't be just blindly following anything, and number two, like, the strategy is hypothetical, so you need to, if you're going to try anything based on the strategy, it should be adjusted to your own risk parameters. But ultimately, for the sake of all this, you need to take things um, into your own personal consideration based on your own objectives, right? You can't just go out here and place trades and expect things to work just because they have in the past. The idea is to study something, understand something, and adjust it to your risk scale. So, but like, let's actually bring this back to to what's going on right now, man. Like, look at these bonds. Is this a bottoming sign to you? Do you think TLT is bottoming here or what?
Yeah, I mean, we're pretty much at Momo. That's the ideal bouncing spot, and that's the place for the best risk to reward to go into bonds. As long as the trend holds, I think bonds are going to head higher. I think we are in a little bit of a hiccup. We basically saw a reversal in conditions that we've seen back in August and September. And the market is basically pricing in more restrictiveness now. And we're going to kind of get back to that point where the Fed needs to cut more. Basically, the same point that we were saying we were in July is that there's too much restrictiveness. And I think we're slowly drifting back to that level of restrictiveness. And I really don't see where the justification is coming from. We got CPI out this week, and it was a little bit hotter than expected, but not by much, very marginally. I don't think that's really a case for a reignition in inflation mentality. And then jobs numbers also came in pretty well. But none of those were really so far outstanding to justify a reignition in inflation and to even really throw out the slowdown probability. So
Yeah.
I don't think this move in bonds is very justified. I think we are entering an overextended territory, and we're likely going to get a bounce off Momo. But obviously, anything's possible. Going to listen to the system, what the system is saying. But at the moment, that's what the system is saying.
Right. So to kind of just elaborate on what you said there, right? You said that it's a good opportunity to get in by Momo. Like these are, and Momo is the orange line. So Momo price is just about down to that point now. We're a 1% away from Momo as of the close. So we're there, right? Pretty much. And this is a good risk to reward opportunity, um, because if this goes bearish trend, right? In our mind, if this goes bear, when price gets down to Momo, you're kind of up against a barrier, because now if price accepts below Momo and the trend flips, well, you're not going to be long bonds anymore, right? So like you're in a position now where your downside is very calculated. Well, it's not perfectly calculated because you need a trend flip, but your margin of risk has compressed versus maybe buying bonds on a dip, say up here or here, right? in the end of August or mid-September, you have this entire range of trend risk here where the trend can consolidate and it may not flip out, so you'll have to eat that drawdown. So when you're closer to Momo, you have more of a wall against your back in terms of where the price should stay above. And for those that are wondering, we bought bonds on July 2nd. So yeah, we were up nice at the end, at the beginning of mid-September. It's pulled back quite a bit, a bit aggressive. I do agree with you, Artie. This is, I mean, this is pretty steep given what we're seeing. It's, I mean, we're talking about obviously a blowout labor print, which is what caused this move here. But other than that, I mean, inflation expectations are really being held up, in my opinion, by like commodity prices themselves. And I mean, we can just look at commodities real quick, right? Oops.
Yeah, I mean, like crude
Oh,
oil is getting
yeah.
highly affected from this war that's escalated in the Middle East, and it's just not really a deep structural issue on inflation just yet. It could become one, but just yet, it really isn't. But I think maybe that's what bonds are picking up here and why they've had such an overextended move, thinking that this war could cause issues with inflation that are deeper rooted if it lasts for longer.
Yeah, and I do see that, like, it's very clear with oil, right? Like oil at 75 a barrel, up above Momo now. It's been a ramp off the lows pretty much since mid-September. Like you'll notice the ramp in oil nearly coincides with like the pullback in bonds to some degree. It's not point for point, but obviously inflation expectations materially reaccelerated here in terms of the market's in what the market was thinking, and that slap bonds. Do I think that we're kind of extreme at this point? Yeah. I mean, this again, we're up against the Momo line here. I'm pretty confident that at least we'll get a bounce regardless. Like if this wants to go below Momo, I think a drive like this, like a drill, when price drills down to Momo like this, you're at least good for a bounce. I mean, if it's only like mid vamp 96, 97, that bounce should be something that I think comes first, regardless of what happens with the price thereafter. But let's also talk about equities, right? The risk on asset here. They're holding up quite well. Still no new 52-week highs on the Qs, but that could very well happen at any point here if we continue to consolidate. I think that the failure for a real, or I should say, the lack of a real move here so far in equities is kind of just going back to what Artie was saying just a few minutes ago, right? You were talking about how like the slowdown probabilities are still there. The probabilities for a slowdown are still there. They were just weakened, and we're still in that zone or that area of slowdown at the moment. Therefore, equities are having a tough time breaking their highs and basically leaving this range that we've been seeing here for the last couple of months.
I
And I
think
think until
I wonder if another factor that's playing into this is these bonds are reversing due to inflation reacceleration fears driven by the war and the CPI print, whatever it may be, um, which causes further restrictiveness when reality is growth is what matters at the moment. Inflation at the end of the day is still pretty tamed, and it's not an issue just yet. But if it's taking it too much as an issue, and starts pricing in further restrictiveness, that growth that never really had a chance to fully rebound starts getting compressed even more. I wonder if that's something that could be holding equities back as well. And then if the inflation component falls off the table, for example, the war, which is a very volatile situation and can change very quickly, if that falls off and we see crude oil back to the lows and then we have growth still not really accelerating that much, then that's not a good scenario for equities. And that's more of a better scenario for bonds.
I think you're pretty much summing up the two macro ranges that I drew up on X, and I think that's a great summary. But I think I need to kind of bring them up so you kind of have an idea of what you're more of a, I should say, a basis of what you're saying. So you're basically saying, like, if we look at 30-year yields, right? 30-year yields going up like this, they're bad for stocks and bonds, right? But the 30-year breaking down below this range is just bad for stocks only. So like we're at this point now where rates are basically doing additional tightening. The higher they go from here, if they go higher from here, that they're going to be a net negative for both bonds and stocks, not just bonds, right?
Yeah,
And
exactly.
one of the big drivers behind what you're saying was the war, right? So we have to bring up commodities. And that too is like commodities are just at that line, that inflation acceleration headline risk line, which we drew as 22 on GSG. We're pretty much right there, right? Like we're flirting with the line. So I think that the scenario which equities want to see so desperately is going to be a situation where the commodities kind of ease up a little bit. Like you were saying, maybe the war premium just dissolves itself or it slows down in terms of how it's being priced into the market. And commodities go range bound between 22 and 20. So they're, we call it 21, right? We go back to early September pricing. And rates do the same thing. I think what's going to happen is you're going to have some relief in bonds, but more so you're going to have the ability for equities to continue their soft landing theme. Right now, that soft landing theme I feel like has been put on pause, and the S&P is grinding out some new highs. I think it just made a new all-time high yesterday, right? Intraday high yesterday. That's not bearish, right? But when we look at equities as a whole, like the objective isn't to say like, is it bearish? Because we have to look at what's going to outperform what, right? So we're not long equities because we think bonds will outperform. Now, bonds were outperforming. We can even talk about this right here. I think this is a good little point to put this in. So bonds were outperforming equities pretty much all the way up until yesterday. And we pivoted on July 2nd. Since then, bonds, the black line here, have been doing very well. And the last, 15, 20 days, they got hit. And equities in the time frame, like equities didn't actually go up as much as bonds came down. You'll see that. Like equities didn't really rise as much as bonds fell. Now equities are above bonds as of this recording, but I think we've seen a lot of pressure in bonds, in bonds where like we haven't seen any kind of resistance in equities, where a small bounce in bonds could easily put bonds back on top of the leaderboard here. We got quite a ways to go to get to gold, but that's something completely different in terms of the conversation between risk off and risk on. But anyways, like it's pretty simple right now. Risk off took a hit the last couple of weeks. Risk on held up, but it didn't really accelerate. I mean, you're looking at things like Bitcoin actually falling, right? You're looking at commodities not really even accelerating above. They haven't even gotten back to the zero mark. So risk off taking a hit, risk on marginally increased. So all it's going to take is a moderate bounce in risk off conditions. And I think bonds again will be back to leading the leaderboards. But I think that we can wrap this podcast up there. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or to go to our website at market-radar.com.